Hello everybody, it's Tom Sheridan and Chris Darbyshire from 7IM here to talk about the Q4 asset allocation meeting and what 7IM is thinking and what we're doing in the portfolios these days. Chris, as you know, is the Chief Investment Officer and the primary architect of those thoughts and the implementation. Chris, over the last quarter, we've had a couple of interesting events in the world. Angela's got re-elected. We had the aftermath of Bernanke opening his views to the world at the end of May, the ongoing saga in China. Paint the macro picture for us, if you would.
So it's been interesting because we've had a few events that could have caused wobbles in the market. But actually the market is pretty much back to the highs of the year, has coped with those risks very well. And part of that is the macro picture. And the macro picture is one of stability. We have positive growth now expected across all global regions for 2014. Not huge in some cases.
Even Europe.
Even Europe has reached the bottom and has turned positive. And I think this is a unique moment post-credit crunch. Everywhere is now showing signs of recovery, different stages of recovery, but recovery is definitely the theme that investors have to take into account now, much more than they did maybe a year ago, where it was still fear of slipping back.
So with the economy looking like we're recovering globally, Bernanke seemed to have tested the waters at the end of the second quarter and got a rude awakening, didn't he?
That's right. The first rumour of a hint of a risk of tapering really wasn't received well by the markets, and we had big risk sell-offs, particularly in emerging markets and emerging market currencies. So the more risky assets really took a bashing.
That was in June, was it?
And that was end of May, beginning of June. We had the big sell-off in Japan at the same time, and actually at that time we had fears about a slowdown in China. So there was quite a lot of negatives going on. I think it's really critical that the market has recovered so well from those wobbles.
So we had the fright of, oh my God, no more QE, and the world wobbled, the world recovered, and I guess what everybody's worried about now is if the world is growing and they are continuing QE, are we not just blowing more bubbles out there?
I think that's definitely a risk. What I would say is that those bubbles are maybe still to come, and that we have a period of time where growth isn't really fast enough in the world to ignite bubbles. That is maybe a 3-4 year picture. It's certainly a risk, but I think you've got a more reasonable period to go through before we get there. Secondly, we don't know if things will play out the way they did going into the credit crunch. So there were certain events, as well as these macro bubbles out there, there were certain events that triggered the bubbles to pop.
Yeah.
And so those events, those are not really in place at the moment. You know, the excessive leverage of banks, excessive valuations in the US housing market. So we don't know if events are going to follow the same course. I think at the moment we're feeling that we like the outlook. Yes, we appreciate the bubble risk is out there, but we'll go with the flow for the time being.
So if we're not concerned of an immediate bursting of bubbles, it's almost unfashionable to be positive in the world these days. You know, heaven forbid we think something good might happen. Now, we've been positioned in the portfolios fairly aggressively during the course of the year. And now that markets have gotten to valuations, well, they're kind of looking pretty close to as high as they've been. People are starting to maybe get a little bit nervous. Your view is we should keep going, huh?
Yes, it is, because although valuations have picked up over the course of the year, they're not necessarily that high compared to historical norms. They're maybe in the US high-ish, but not outrageously high. Secondly, you would expect valuations to be somewhat high at the moment because we are still coming into full recovery mode in the US and into the beginning of a recovery in other developed markets. And the other asset classes out there really don't look that appealing.
So these valuations you're talking about are equity valuations?
Yeah, so equity valuations I would expect to be high and to remain high for a while bond valuations look really so unattractive.
Okay, so the overweight equity position that we've had in the 7IM portfolios has had some regional nuances to it, and some of those regional nuances we may see the sands being shifted on us. Tell us about the US, Europe, China, Japan. Where were we? Where are we going?
So over the past few weeks, we've looked at valuations in the different markets, and we've prioritised three themes: valuation, a re-rating of valuation, and just a turnaround story in an economy generally.
Valuations, re-ratings, and turnarounds.
Yeah.
You heard it.
So for the valuation story, we've got the US, where valuations are quite high, and it has had a fantastic run for several years compared to other regions. We like the US, but we just think it's had its day in the sun, and therefore we're going to underweight the US going forwards.
It's not illogical, really. I mean, it went into the downturn first. It's come out of the downturn first. The markets recovered there earlier than other markets. I could perhaps see the logic for that. And I think many of our clients will as well. But the rest of the world?
So what are we doing with the money we're taking out of the US? So we're moving, mainly that money is going into Europe. And within Europe, it's going into small and mid-cap companies.
Interesting. That's a bit different.
Yeah, we think...
What's the thought there?
Well, we think Europe is really about turnaround and re-rating. So we think that what's happened in the US, where you move from average to high multiples, is going to happen in Europe. You've got the recovery in Europe beginning to look sustainable from the macroeconomic data. We've got the global picture looking better, which helps European companies because they export and they benefit from global trade flows. So put that all together, and Europe begins to look like one of the most interesting markets.
Is Europe Germany in this case, or is it more than that?
Well, it's more than that. It's really a mix of Germany, France, Italy and Spain, with a skew towards Germany and France, perhaps.
And where are we on Japan and emerging markets?
So for Japan, we like the story in Japan. We think there's a lot of very good things going on there. The market is beginning to lose a bit of faith in the Prime Minister's actions there. So Prime Minister Abe's new approach to the economy known as Abenomics.
You might, just for those people who didn't watch last quarter's video, they've taken an extreme position in Japan. Just a one or two sentence recap of Abenomics.
Very unique. It involves the government working hand in hand with the central bank to engineer a big change in the economy through increased inflation, through stimulus, so more government debt being ploughed into projects to boost the economy. And the third part of the strategy, which we've yet to see fully come through, is about changing the culture, the working practices of Japan.
That's a massive agenda. They're talking about doubling the money supply in 4 years. That's a staggering statement to make. But politically, there's a little bit different positioning in Japan than the rest of the world.
So I think this concept of the central bank being aligned with the government in Japan is unique. If you think about what we've got in other economies, even in the US, we have the central bank trying to stimulate and the government really in austerity mode, trying to cut spending. And those two really are sending opposite messages. Same goes for Europe, where central bank policy is pretty loose and that helps the economy, but the government really is in austerity mode, particularly in the periphery, which doesn't help the economy. Whereas Japan, I think this is a really interesting story because you really do have consensus.
So we've had one leg up, markets digesting, and again, the view in Japan is stay the course, go back to the overweight position, which you had lightened up on, to your credit. You're going to go back to a heavier overweight.
Yes, so in the balanced portfolios, for example, will be 9% exposed to Japan rather than a 6% strategic sort of neutral position.
Yeah, that's quite a big allocation. Emerging markets. This could be the big story in the 7IM portfolios for the balance of the year.
We've taken a significant position in emerging markets, and the theory there is really valuation again. Emerging markets have maintained reasonable earnings growth coming out of the credit crunch. At the same time, their ratings have really fallen. So people have gone off emerging markets as an investment, and the risk perceived risk has increased over the summer. And you saw that with fears of a China slowdown, then currency runs on various countries, and there were some political crises in various emerging market countries. This sent the valuations right down to a point where we felt, the long-term growth prospects are good, still a great investment case there, and we thought we'd take a position expecting other investors to come around to share that point of view.
Okay, so on the back of Bernanke's comments in May, not only did the emerging market equity markets suffer very badly, but the currency markets also simultaneously suffered, leaves us with very attractive valuations, as you said. So the equity picture has become fairly clear. We're staying with an overweight position. We're adjusting a little bit from the States into Europe, into emerging markets, into Japan. Fixed income markets, we've seen on the back of the Bernanke episode, if we can call it that, that we've referred to before, longer term rates in government bonds rising a little bit. Not far enough though, huh?
I don't think so. I think the conditions are in place for quite a significant rise in bond yields. We still have massive distortion in that marketplace from the Federal Reserve and other central bank buying of government bonds. And we still have economic growth beginning to come through and beginning to solidify. So I think together, bond yields probably have further to go. And we've reflected that in the portfolios over the last few weeks, where again, we've taken duration, so long bond risk off the table.
That's been a massive theme for you over the last, during most of this year, actually. So most people will say if you're looking at fixed income, you've got duration or how long are the maturities, you've got credit risk and you've got currency risk. We have tremendously shortened our duration position within fixed income. So in taking overall fixed income weightings lower than normal and in reducing the duration, we've taken a lot of fixed income risk off the table. Where did you put it back on?
So partly it's gone into equities, which we think are a type of risk which will yield better returns over the short term. Partly within fixed income, it's gone into areas of the market where we think will have more upside, such as the high yield part of the market.
Yep.
And we've also moved some of that into shorter term fixed income assets, really cash proxies.
Okay, but on the government side, we have moved from global governments to Spain and Italy, for example. And that was on the basis that your view was really credit risk is the European Central Bank and not a whole lot different than Germany. Actually, it might actually be Germany.
Yes.
And so you're getting the yield pickup on short-dated Spain and Italy. That's worked rather well.
Yeah, big yield pickup, shorter duration. So we take duration risk off the table. We get a yield pickup significant compared to UK short-term bonds. And yes, we take on some risk, but risk that is really backed and by the ECB. So it's a very attractive investment at the moment. It continues to be. In fact, we've moved more into Spain and Italy after the recent TAA process.
Okay, so the recovery story has as high yield, Spain and Italy being higher risk, perceived higher risk anyway. You've had a couple of very interesting forays at the floating rate note exposure. Explain for the to the clients what we've done.
So the floating rate instruments, the interest rate on them and the yield you receive goes up as interest rates go up. So they give you complete protections and no duration risk whatsoever. And they actually could start to produce quite reasonable returns if rates do go up. And there's been a big flurry of activity in these markets. We've had significant investments over the last 6 months and have moved more. And when I say high yield, that's really what I mean. Part of that is the floating rate market.
This has been such a central part of what 7IM has done this year. Our worry coming into this year was in a period of obviously rising fixed income yields, what do we do for the cautious client? And so far this year, we've managed about a 5% return after cost for the cautious client, which is in line with our longer term expectations in an environment where it's been very, very difficult, and you haven't gone overboard in throwing equity into the portfolios. I think a neutral position of 27% versus an actual of about 31%. So well done on handling the cautious client in this very difficult environment.
I mean, it's a good point that when you look at how our different funds are positioned with regards to risk, the more cautious portfolios, although they're above the neutral level of risk, are only slightly above the neutral level of risk.
Yeah, and that's very, very important that we maintain our promise to the clients to keep them within the level of risk that they signed up for, regardless of the market conditions. It's also, in my mind, an extremely strong argument for taking a tactical view and not automatically rebalancing. If we were in a position where we forced Chris to automatically rebalance in this environment, the returns that we've achieved for the cautious client this year, well, they simply wouldn't be there.
I think that's right. The bond story is going to run, and when you rebalance, you really go against that story every time you rebalance.
Okay, so we've got a good picture now of how we've handled the equity asset class, a little bit more in equities, but a geographical shift within the equities. On the fixed income, a little bit underweight, very, very heavy accent on reducing duration, introduced some credit risk. Now, currency. Possibly the least understood and largest variable in some of these portfolios, particularly global portfolio, currency risk. Now, the dollar has had an interesting quarter, and you've actually come out pretty well on the position. Tell us what you did.
So we really became bearish on the dollar several months ago. It wasn't, I think, consensus at the time to be bullish on the pound, bearish on the dollar. We began to hedge our dollar exposure. Any modern sort of multi-asset portfolio necessarily in today's world has a lot of dollar exposure, because you don't just have dollar assets, but you have a lot of emerging market assets that are linked to the dollar.
Yeah. And for those of you who are, this can be up to 25% of the portfolio. Absolutely. Where you have actual or inferred dollar exposure.
Yeah, and 25% is your biggest single risk.
Yes.
In many of these portfolios. So, one tends to think UK equities, but it's not. It's really US dollar is the main risk. So we were very active hedging that over the last few months. We've been increasing the hedge up until really this morning, when we felt that there was a sea change going on in the rise of the pound and the strength of the pound, which had been boosted by debt ceiling concerns and shutdown concerns in the US. So this morning we unwound that hedge. So we've gone back to our neutral position, which is to be exposed to the dollar.
So that rounds out the picture very well. We've got the equity story, we've got the fixed income story, and we've also got the currency component, which is the one that most people tend to overlook. Well done, and thank you very much.